Hey, what's up, guys? It's Wednesday, June 18th. I realize I was having a discussion with a subscriber today that I haven't really covered exactly how to build a portfolio or how to enter these positions and stuff. So that's what I wanted to sort of talk to today. Is talked about general strategy for the speculative side of our fund, which is the side that mostly holds biotechs that you guys are playing. So I want to talk about AMLX. And this is a stock that I don't talk about very much in chat. And the reason why I don't talk about it is because we have had a position in this in a very, very long time, and we're just riding it. We haven't made any changes to it. We haven't sold it. We haven't flipped it. And the reason is because for me, this was on my radar in summer of 2024 because that's when I was actively trying to get the cost down. For me, it's just something I think this is like the fifth or sixth largest position that we own. And until I sell it or until it actually reaches one of our exit points, there's not really anything for me to do about this. It just sits in the account. So it's not something that I ever think about discussing. But what I want to do is explain to you how this entire trade worked, because this is a pretty typical way that we actually handle positions. So I'm going to go back and I'm going to look at the chart from, let's go back to February of 2024. So I'll sort of work you forward here. All right, so February of right here. All right, so this is where the stock was before the event. Now our older charts didn't have the event that's on here, but as you can see, this is not into a position that we would have ever played it, right? This is far above the channel. So at some point in March, and I don't remember what the news was. Just grab this one. Okay, the stock actually fell, but it did not completely fall through the channel. As you can see, it got to the bottom of the channel, had a little bit of a bounce, but then sort of bled out. Once it crossed the EM0 boundary, which is the bottom part of the channel here, is when we bought it originally. Now, I don't remember what price we paid for it. It's saying on the chart it's 274 is what it was on this random particular chart. Now, this is a stock that what we were doing is we bought a core position and then we were prepared to double into it 2 or 3 or 4 times, however many we needed to, and then we would flip it when the opportunity happened. So we bought this, we started acquiring it, and then at some point later in the year, like you can see, there were various times where this bounced and various times where it drifted below. Now, what we were doing this whole time is we basically were playing an umbrella strategy where we were flipping a secondary. Now, when the stock actually started to rebound, okay, what we did is we played the dots here. So when this institution file, this 13G happened, is when we would have stopped flipping it, okay? Now, when it left the channel, you guys know that typically I sell when it leaves the channel. So I don't remember, I know I did not sell anywhere near the peak, but we basically sold somewhere around this time period, and then we waited. So this return here was from whatever, $2.70, $3, whatever we had, until $5. So it was a 60% return. Now, there were news events during this time period. So after we make our initial return, what I do is I evaluate the news to see if this is actually a position that we want to re-enter, or if it's something that we want to actually ride. Now, in this particular case, we have profits. So we can basically buy the stock back completely with profit, but essentially be a zero-cost trade for us if we wanted to. So what we do is we sort of monitor the stock. So and what we're looking for is we're looking for continued support for new institutions. We're looking for changes in the data. We're looking for proper fundraises. Like, for example, I don't remember what the fundraise that this one did, but you're looking for a stock that raises capital at a 1-to-1 ratio. You know, basically they pay for one share, they get one share. Ideally, you're looking for a fundraise that happens above the closing price, or, you know, within a certain range of the closing price. you're looking for a situation where during the fundraise, the stock doesn't immediately sell off intraday, because that's a sign of distribution. There's a whole bunch of things that you can monitor when the stocks move to determine whether or not the stock's actually going to be buoyant or not. And that's basically what we've done is we flipped this initial position, which got us profit. And then we started buying back during when the stock was stable. And you can see it tripped our liquidity here. Now, by this particular time, we had a lot of conviction in this play. So we've just been riding it. And that's what we're going to do because we're basically riding a free position. And we'll ride it up until the point where we start to get, grab the latest chart here, where we start to get nervous, where where you start to get to orange events, or if this starts to goes parabolic or something like that, or if there's too much social activity, anything that starts to make us nervous. But in this particular case, you're looking at a buy of $3.50 or $4 or something like that, and it's sitting at $5.33. So we had a 60% plus move originally, and then we have another 60% move in profit. And that's, so this is not active for us. I mean, this is a situation where we have a running ask. I think the running ask is like 60% of whatever the closing price is, so that we'll catch any spikes. But this is one that we're just going to run because it's, it's a free position for us. I hope that sort of explains one example. I'm trying to think of what one of our other really large positions is. Well, we don't have a full position of this yet, but most of you guys know we played this last year, right? From 2023 into 2024. And I think a lot of you actually were involved in this initial move and the options play that we played here. Now, once we exited, we still waited. So we've actually bought, it came below the channel again, and we actually started buying this back again. Now, again, we made so much. This was like 90 cents to $11. I think we sold it like $8.50 or something. We made so much money on this that we're basically running a free position here. Like anything that we buy back, we're buying back in pure profits. So that's how we're playing this. And if you notice, both of these stocks, like once the initial liquidity phase happens where, during the IPO, you basically, everyone dumps or they short. And then at some point, they basically buy back and they tie up liquidity, which is what all these little green dots are for. Now, between here, which was the initial news, and when the stock actually starts to become risky, which will be later phase trials and stuff like that, stuff that's not green on the chart, there's a long waiting period of which the algorithms and, retail shorts mostly are just going to sell out. So this gives you time to basically, decide whether or not this is a play you want to remake or not. And we have. This is a stock that we've been re-entering pretty heavily in the last couple of weeks here. Now, these are for stocks that are, I don't know what the opposite of scam is, but these are plausible plays. Now, the odds of any drug trial actually working, going all the way through phase 3 is extremely small. So we don't assume that anything is going to transition. But these stocks are also not the stocks that I've written about before that are just, dilutive share selling nightmares. So going in and out of these positions based on the channel is something that we may do, 2, 3, or 4 times over a multi-year process. Like you have the initial load phase, which is usually early, the IND phase, the pre-phase 1 results. And then you have the transition between phase 1 and phase 3, which is when stocks tend to actually start to either pick up interest or, they start to have bad results. So, which is why we basically start selling stuff when it's yellow or orange on the graph. I'm trying to think of what would be a good example of a stock that we entered and then we stopped playing. I'm not sure. I can't really think of one right now. They're pretty easy to see. Stocks that basically spike and do really bad offerings, 3 for 1, 2 warrants plus a share for 1, or the company itself cannot they can't file under an S3, so they have to file an S1 late, that kind of stuff. We rarely play those more than once. Like we will do the same thing that we've done with C4, which is we'll enter in a speculative position before there's any data. But once the data comes out, once we see how the actual offerings and the fundraisers all handle and what the data is, we'll usually walk away from those stocks, at least for a while. One that we played, we actually played this one. It was called Asana. This is actually something that is reverse merged. So we played this years and years and years ago. So something like this, even though it was falling through the channel, there's really nothing about this that we were interested in because of the debt load and everything else. But now that it's far below the channel, this is now interesting again. But this play, we expect, because this is a stock that's going to have to file an S1, we expect in this FST there to be a spike, but this isn't a situation where we would be willing to hold it. We would basically sell whatever the data was, whatever the pre-market move is, and then we wouldn't pay much attention to it. So maybe that'll help. I'll try to think about and try to come up with some more stuff to fill in with you guys. But I'm trying to, what's one that we're in now? Okay, so here's another example. Again, this is the speculative entry phase. This first move is where you basically make all your money, and then you have to decide when to get back. So if we go back and we look at October, let's look at September of last year. I don't know why our servers are so slow right now. All right, so you can see here that in September of last year, it still had not crossed the channel again. So whatever this move is, okay, like you can sell immediately on the move if you want. You can do what we do, which is what you wait and actually see what the investment activity is. So we actually sold somewhere up here. I remember it was over 8, but I don't remember exactly how over 8. Now you can, in this case, you could just walk away. Like, and this stock could have taken off and we could have missed it. Or you can judge the news and decide whether or not there is going to be a buyout. And that's kind of what you're looking for in stuff like this. When the early phase trials happen, the lag time between the trials is usually very, very, very long. So no matter what happens initially, okay, it's probably going to bleed out. And the reason is because people get bored. Like, they're not going to wait around. Now, the other example is sometimes if the news is really, really good, you expect a buyout. So back to Static Lab. So we played the speculative phase. I know that we started playing this like way back here in 2022. But most of our profit was made here in this jump rate. And as of the end of last year, the stock was still too high for us to actually take a position in. So it came down recently. So right here, it's been basically jumping back around, and it's just now sort of dipped below the channel. So this is one that we're playing with profits here. This is one that we're in a second round with. To give you an example of one that we bought back sooner than later, I talked about this one before. We had a speculative position that jumped. I sold it, which was our play. And then after reading the news, I realized that selling it was a mistake. So I actually bought this back. I actually paid more for it, like probably 15 or 20% more than where I sold it from. And this is one that we still already had our profits, but we were willing to risk profits here just because it looked like this was one that was going to, basically do what it did. So this is one that the data was really, really good and ended up getting bought out. Now, these sorts of things are hard because counterintuitively, the reason why I was confident to buy back is because this company did not do a fundraise. Like, once the data came out, they did not try to capitalize it. They weren't setting up for a continued round of funding. They had enough confidence that they were going to get that money without having to basically dilute. And if you compare that to, Shattuck here, you can see that they actually actively did raise capital during this move. Okay, so now That's not always a tell. CMRX, the company that ended up buying that, I forget who it was. They were actually an early investor, so there was a linkage there that we were able to connect, which gave us a little bit more confidence. But when they're raising capital, it's a pretty good sign that they actually intend on taking the drugs to trial themselves. So I hope that clears things up. And right now, I think we're running 90 positions in this particular part of the fund, and this is the speculative stuff is relatively speaking fairly small compared to the whole size. But I hope that helps you guys understand how to transition between plays. Just ask me questions, because I don't actually know what everyone needs to hear or what they want to hear in this. So, all right, hope that helps.